Welcome to the wonderful world of fixed income securities. We're going to spend a fair amount of time here diving into fairly intense material. So the fixed income material, I think, is very well thought out, and the presentation is something that is actually useful here. And if you don't know a lot about fixed income securities yet, by the time you get your charter, this is certainly going to help you advance that particular area of your knowledge. If you're not familiar with them, though, this can be a little frustrating, so plan on slowing down a little bit as you enter this fixed income stuff. Now, if you're a fixed income trader, or you got a master's degree in economics, well, we hope your therapy's going well. But if you've done this stuff before, then of course there's nothing new under the sun. But for a lot of people, this ends up being a little bit frustrating, and I think it's fair to say that the rigor in the fixed income material has increased over recent years. So plan on spending a little extra time, I guess, is my point. So we're going to start out with a fairly intense reading. They don't give you a whole lot of warm-up time here. This is going to be the term structure and interest rate dynamics, and we're going to dive right in probably to something that you don't like, and that's going to be all the spot and forward rate stuff. So before we do this, let's take just a minute and remember some definitions from level 1. So when we talk about a yield to maturity, okay, a yield to maturity is a single interest rate that we use to discount all of the cash flows in a bond back to today and when we find the yield to maturity by forcing the value of those discounted cash flows to be equal to the market price of the bond. So that's going to be a single interest rate. It's going to say, okay, if we discount all the cash flows at 4%, we get a discounted value of $93, and that's also the market price. Okay, so that's just a yield. It's a single interest rate. Now, if we talk about spot rates, okay, and spot rate curves, and we're going to spend a fair amount of time working with this, and I think you're going to have to make your peace with spot rates, and we'll talk about forward rates in just a moment. You're going to have to make your peace with spot and forward rates because they show up here and they show up in a couple of other places in the curriculum as well. And they're not all that difficult to deal with. It's mostly terminology that scares people, I think. But nonetheless, a spot rate is a rate that we use to discount a single cash flow at some point in the future back to today. So if we're looking at time, and we have, 1 and 2 and 3 and so forth, years to maturity, then we can look at spot rates, which I'm going to call S. Well, if these were yields, we would have, if we looked at a 3-year bond, we would have the one interest rate we use to discount cash flows at time 1, 2, and 3, all back to today. But if we're looking at spot rates, we are going to say, well, we want to discount this bond. We want to get the value. We want the discounted value to be equal to the actual market price. But we would use 3 different rates. We'd have a 1-year spot rate, a 2-year spot rate, and a 3-year spot rate. So when I draw a yield curve, just to remind myself, we're looking at time against yield, I always draw it as a solid line. Okay, to remind myself that, if I have a 3-year bond, I come up here, I find the 3-year yield to maturity, and I discount the cash flows. When I'm doing a spot rate curve, I draw these as dots to remind myself that, this only applies to a cash flow that comes at time 3. So it's one bond, I get a cash flow at 1, 2, and 3. This is the interest rate for time 3, this is the interest rate for time 2, and this is the interest rate for time 1. All right? So those are spot rates. Forward rates are short-term rates that are expected to exist in the future, is the best way to think of it. Where I could have a 1-year interest rate for a loan that starts 1 year from today. That would be a forward rate. So there's short-term rates that are going to exist at some point in the future. And the relationship between spots and forwards is fairly tight, and it's easy to go from one to the other. But the terminology, I think, is off-putting to a lot of people, so you're going to have to spend a little bit of time thinking about what the terminology means and why it seems so cumbersome and that sort of thing. All right? So spot forward rates, you can't just jump from yields into spot rates or yields into forward rates. You have to use what's called a bootstrapping process that we'll look at briefly. I don't know that that's all that important. Being able to take yield to maturity and go into to originally bootstrap out a spot rate, okay, but going back and forth between spot and forwards, I think is something that you are going to have to learn. So spot rates, these are the yields on a 0 coupon bond, okay, that is a cash flow that comes at one point in time, so there's no reinvestment risk there, and the spot yield curve is just what I've drawn here. Okay, that is the yield curve for spot rates, and you can see this is an upward sloping yield curve. Now what we'll also observe, and you're going to see a very complicated looking picture in a little while, but all it's really saying is, look, if we have time and then we have yields and we have spot rates, and we have forward rates all in the same curve, then the yield, they may look like this, okay? Then the spot rates, okay, are going to be upward sloping at a greater rate. If the yield curve is upward sloping, the spot rate curve is going to be upward sloping at a greater rate, and then the forward rate curve will be upward sloping at even a greater rate. And then the same thing would happen if we're going down. It would be, you know, yield to maturity, spot rates, and then forward rates like that. All right, so anyway, the forward rates are going to lie the farthest from the yields, and the spot rates will be in the middle. So a spot rate or spot yield curve, something that you want to keep an eye on, because we're going to be working with this a lot. So forward rates here, as I just talked about, this is the annualized interest rate on a loan that's going to be initiated in a future period. Forward curve, so forward rates versus maturity. Again, it's going to, if the forward curve's like this, then we're going to have the spot curve, then we're going to have the yield curve down here. So the forward curve and spot curve are mathematically related, and this is where we get into the notation. So F sub JK, okay, is the annualized interest rate applicable on a K period loan starting J periods from today. So K, the second number, okay, J is the first number, so starting J periods from today. So we had an F11, okay, that would be a loan that starts 1 period from today and lasts 1 year. So the loan matures at J plus K, right? So the loan would start 1 year from now and mature 2 years from now. If we use a capital F, then we're talking about the forward price. So it would be the forward price of a $1 par value, 0 coupon bond for K periods that you could buy at time J. Right? So it's this F sub JK and F sub JK, capital, lowercase, and uppercase, that I think gives people some heartburn. All right? So, and this is a forward price, right? So F is, again, a forward price. Lowercase f is a forward rate. Okay? All right, so what about the yield to maturity for a coupon bond? Well, all right, so thinking of this, we have a 3-year, 4% annual pay, $1,000 bond. That means we're going to have cash flows of what? Well, it's 4% coupon, so we're going to have 40% or $40 payment 1 year from today, $40 payment 2 years from today, and then $1,040 3 years from today, the final coupon payment plus the return of principal. Well, if we know what the spot rates are, right? So the 1-year spot rate, we read off the spot rate curve is 5%. The 2-year spot rate curve is 2-year spot rate is 6%. So that's the rate we would use to take a single cash flow 2 years from now and discount it back to today. But remember, they're annually stated, so we would have to, bring it back 2 years at 6%. And then the 3-year spot rate is 7%. What's the value of the bond today? Right? Well, we're going to say, well, we got this $40 cash flow coming at time 1. It's 1 period away. The 1 period spot rate's 5%, so divide it by 1.05. We have $40 2 years from now. The 2-year spot rate is 6, so we're going to divide that by 1.06 squared, because we got to bring it back 2 periods, right? And then the 1,040, we're going to bring back 7%, and that's going to be cubed, because we're bringing it back 3 periods. That tells us that the value of the bond today must be $922.64. Why must it be? Well, we actually don't talk about that until a later reading, but this has to do with the idea of arbitrage-free pricing. All right? Now, if we come down here and do what we did at level 1, right, and that is to plug in, we play the 5, find 4 game on our calculator. So we plug in the 4 things we know about our bond. It's 3 years to maturity. The present value is $922.64. The payment is $40, and the future value is $1,000. And then we solve for the yield to maturity. Notice that what we get, okay, is 6.94%. Okay, well, does that make sense to us? Well, look at the spot curve, right? So it's 5, 6, 7. It's upward sloping. So let's see, we're discounting some of the cash flows at 7, some at 6, and some at 5. But because we have a big cash flow at the end, that's discounted at 7%, and it's also discounted 3 years. That 7 is going to be really important, right? Okay, but if you think, well, the yield to maturity is 6.94, notice that it is between the extremes of the spot rate curve. It's between 5 and 7. It would have to be, right? Because, think weighted average, right? So this is discounted at 5, this is discounted at 6, this is discounted at 7. Well, because it's a big number and it's 3 years, that 7% gets a lot of weight. So we end up with a yield of 6.94 that is between the 1-year spot rate and the 3-year spot rate. I'm not sure that's a huge deal, but something you want to keep track of. Okay, so that is valuing a bond with spot rates. Pretty straightforward. Okay, what about expected return? So the ex-ante holding period return an investor expects to earn from buying this bond, holding it for that period, is the expected return. Okay, the expected return is going to be equal to the bond's yield. Okay, that is, we just calculated 6.94% as the yield to maturity. Okay, we sometimes call that the promised yield on the bond. Okay, well, when is that actually going to be the return that you earn? Well, I like to call this the broken promise yield because it's not really ever going to happen. Why? Because if you buy this 3-year bond today, you pay $9.22 whatever for it, okay, then here's what has to happen for you to earn exactly 6.94%. One, you have to hold the bond to maturity, and okay, the coupon and principal payments have to be received on time, and okay, all the coupons have to be reinvested at 6.94% until the end of the life of the bond. So you get the first coupon payment a year from today, you invest it for 2 years at 6.94. You get the second one, you invest it at 6.94, so you have the reinvestment return. Then you would earn exactly the yield to maturity of 6.94%. Okay, so reinvesting the coupons at the yield to maturity is not a particularly realistic assumption. So the yield to maturity, aka the promised yield, aka the broken promise yield, okay, is rarely going to be the ex post realization for the return on your bond. Okay, forward pricing model, and I think this is a little bit, this is where people start to get a little confused. If you need to, slow down. That is, pause the video. I'll still be here, still handsome on the screen, right? And if you need to think through what these relationships are, because if you get too far behind, if these next few slides don't make sense to you, then there's going to be a lot that doesn't make sense to you going forward, all right? So the forward pricing model, we can use the forward pricing model to value forward contracts using an arbitrage-free pricing. We're really going to talk about arbitrage-free pricing later, so let's don't worry about that too much right now. Let's just think about the relationship and the arithmetic. So investor A purchases a $1 par, 0 coupon bond maturing in J plus K years. All right? So what the heck does that mean? Well, J plus K, well, that's J is, the time until a loan starts, and K is to the period that it's outstanding. So J plus K is, a bond that matures in J plus K years, right? So if this were, 3 years and 2 years, well, this would be just a bond that matures in 5 years, and the price of that bond today would just be, we're denoting P, all right? So it's a $1 par bond, 5 years from, with, J plus K, I'm using the example of 5 years, okay? How much would you pay for that today? Well, the point here of this forward pricing model is that we have another investor, investor B, okay, that enters into a J-year forward contract, okay, to purchase a $1 par, 0 coupon bond that matures in K years. So in this case, we had 3 and 2, so we're going to enter into a 3-year forward contract to purchase a bond that matures 2 years from the expiration of the contract. So we've got one investor that is saying, well, I'm going to invest at time 0 and a bond that's going to mature at time 5. And we know that the price of that is P sub 5. I'm not going to write the J plus K. Okay, we have another investor who's entering into a 3-year forward contract, okay, but then at that time is going to buy a 2-year bond. So this will be time 5, so the interim will be 2 here. Okay, and we know we can calculate what this forward price with a forward price of this 2-year bond will be at time 3. Well, the point here is that under this arbitrage-free pricing, and this depends critically on something we talked about at level 1, we'll talk about again later on, this idea of the pure expectations theory, but nonetheless, what this is saying is that we have the price of this bond, okay, that at time, this J, this is going to be, we're going to enter into a contract to buy it at P sub J, and I know you can't read that, so I'm going to draw an arrow down here. So it's going to be P sub J, right? So that'll be the price that we agree to buy this bond at 3 years from now. Well, and then we've got to discount this back. I may have messed up my notation. Let me think real quick. Yeah. So I'm sorry. This should be an F, right? So F sub F sub JK. And I should be using a lower k. Sorry about that. So F sub jk, I told you it was the notation that drives everybody crazy, including me. So that would be the forward price to enter into for a 3-year contract to buy a 2-year bond. Okay? And then we also would have the price of a J period bond. And what we're saying here, and I know this is kind of a mathematical leap, but what we're saying is that the price of the bond for investor A, okay, is going to be the same as the investment for B, right? So these two investments should have the same price. So if you take the price of a 3-period bond, right, and then multiply it by the forward value or the forward price of this forward price J sub K, it's got to equal this P sub J plus K, all right? Now, why is that? That's hard to stomach, I realize. So think of it this way. Let's use a simpler example and ignore compounding for a moment. What we're saying is this. Look, I could have had one investor that entered or bought a 2-year bond, right? And the 2-year bond, let's say it had a yield of 4%, right? So that means that I would have earned 4% here and 4% here. Does that make sense to everyone? So 4% plus 4%. So over the 2 years, ignoring compounding, I would have earned 8%, right? Well, all this is really saying is that if I have another investor who enters into a 1-year bond, okay, so from 0 to 1, and at the maturity, or buys a 1-year bond, at the maturity of that 1-year bond, then buys another bond that goes from time 1 to time 2, well, what we're locking in is a 3% return here. Okay? So they have a 3% 1-year bond, a 4% 2-year bond, upward sloping yield curve. What is the return that we've locked in here? All right? Well, as it turns out, under what we're doing, this forward pricing model, what's driving this, in the same mathematics is that, well, it doesn't matter how you slice up this holding period, okay? You have to earn the same return. So we're going to earn 8% on this as well, right? And that means that what has to go in here, absent some compounding, is 5%, right? So we have 4 plus 4 is equal to 8, and we have 3 plus this forward interest rate, which is going to be equal to 8 as well. That's what makes these two things have the same price, all right? So the forward pricing model is saying that, you know, it doesn't matter how we slice up the periods, okay? We are going to end up with the same price because we have the same interest rate in both options. Okay, I realize that some of you are out there going, what the heck, right? Or maybe worse than heck. Anyway, but the point here is, all we're doing is working between periodic rates, right? So we have this, you know, J period rate and a K period rate that starts at time J, and we're just saying that it doesn't matter how we slice this thing up, okay? You've got to get back to the same result. That's the forward pricing model, all right? So let's push forward a little bit. I realize that that may not be completely clear at this point, but I think it may clear up as we work forward. So the forward rate model. Okay, so it's going to relate forward and spot rates is what we just basically said. So what this means, and all of this, oh wow, look at the notation on this puppy, right? So show that to your significant other and see if they think you're crazy for sitting for the CFA exam. So what is this Sj plus K, right? Well, remember, J we said was 3, K we said was 2. So what this is, if we want to follow my little example, is it's 1 plus S sub 5, right? So that's just the 5-year spot rate, okay? And then it's raised to the J plus K period, so that's going to be to the 5th power, right? So if the 5-year spot rate is 5%, well, that means if we want to discount something back, we got to do it 5% for 1, 2, 3, 4, 5 years, okay? And if we're going to bring something out going forward, we got to take it forward 5%, 5%, 5%, 5%, 5% to get it out 5 years, right? So this would be the rate that would apply to the entire 5-year period, right? And that's going to be equal to 1 plus, okay, and if we look at this, what is that term? S sub j, well, remember, j was 3 in my little example, so j is equal to 3, and k is equal to 2, right? So this is going to be 1 plus s sub 2, and it's going to be squared, so we're taking that out 2 years, okay, and then we're going to multiply that by this 1 plus fj sub k. Now remember, this is where you have to make sure you're interpreting this correct. So f sub jk is the rate on a k period loan that starts j periods from now, right? So that's going to be whatever that rate is. It's going to be 1 plus, okay, and the only way to write it that I know of is the way they have it, 3 comma 2, Okay, and that's going to be squared because it's going to apply to 2 years. And all we're saying is that has to be the same. Now, does that make sense? Well, let's think about it just a little bit more. So what we're saying is, look, we have a 5-year rate. Okay? And this 5-year rate, okay, we can earn 5% and 5% and 5% and 5% and 5%. So ignoring compounding, we're going to earn 25% on this investment, right? Compounding would start to be significant if you have a lot of periods. But we're breaking it down into a 2-year rate, okay? And nope, we're breaking it down into, this should be 3, right? A 3-year rate, sorry. So a 3-year rate and then another 2-year rate. Okay? So the point is this. Look, if we know this, if we know what the 5-year spot rate is, because we have a 5-year spot rate curve, and if we have a 5-year spot rate curve, and where we get this we'll talk about in just a moment, okay, then we know the 3-year spot rate also. Maybe the 3-year spot rate is 3%. So that would be 3 plus 3 plus 3, right? So we've earned 9% over the first 3 years here. We know we have to earn 25, right? So what is the forward rate that we're going to earn? Well, if we earn 9 here, it's going to have to be equal to 25 over here, right? Because that's what we earned on with the 5-year spot rate. Okay, well, if that's the case, then we've got to earn, what is that? Over this entire period, we've got to earn 16%. So we could break that down, and we could say 8% in each of these periods. So the spot rate curve is upward sloping, looking at time against spot rates or forward rates. So the 3-year rate is 3%. Okay? The 5-year rate is 5%. That came in handy. So this is my spot rate curve, right? Do with dots. What about the forward curve? Then the forward curve has to be upward sloping at even a greater rate. So when we get out here to these loans out for 3 years out, we'd expect to see it to be greater than 5%. All right, let's plug in and see if we can make sure I didn't miss anything here. Okay, yeah, so we've effectively locked in this 8% return for these last 2 years. By buying the 5-year bond, if this is what our option was for 3 years, we've locked in 8% for these last 2 years. Now, that ignores compounding. But you're going to be surprised at how little difference compounding makes as we go forward. So we're going to do this right, and then we're also going to do it as an approximation, and you're going to see how easy that makes it. So anyway, so here's their example. So new example, forget my 3 and 2 and all that sort of stuff. Let's look at what we have here. So the 2-year spot rate's 4%. The 5-year spot rate is 6%. So what we've done is taken this equation that we were working with on the last slide, and we've just solved it like it's an algebra thing, right? So now what we want to know is we know what this the 5-year is it 5? Yeah, the 5-year spot rate. So J plus K. So they're doing 2 and 3. I did 3 and 2. Okay, so we know that, and we also know this, right? So that's the J-year rate for 2 years. Well, if we take this, the 1 plus the longer spot rate, and that's got to equal the short spot rate plus the forward rate, and we rearrange that equation, okay, then what we get is what we see down here, right? So we're going to get this 1 plus the forward rate to the kth power, okay, and then we're going to have, the big rate over the longer rate over the shorter rate de-annualized, so we got to make sure and have the right exponent there. But what this says is that the forward rate, the 3-year forward rate that starts 2 years from today, okay, and in this case, we've got to make sure that we understand that it's going to be, to the 3rd power because it would apply to 3 years. It's got to be equal to 1 plus the 5-year rate to the 5th power over 1 plus the 4-year rate to the 2nd power, right? And since we know those two things, we can solve it. That's just going to be a term. So 1 plus this forward rate is going to the 3rd power is going to be equal to 1.23. If we take the cube root of both sides, what we end up with is that the implied forward rate, given the spot rate curve, the implied forward rate is 7.35%. Now, does that make sense to you? Well, probably not, but let's go back and try our little, our logic on it again and see if all that would play out. So here's what we said, okay? If we're looking at this for a 5-year loan, right? So, and the 5-year spot rate is 6%. So we're going to take, 6 and 6 and 6 and 6 and 6. Well, if you get 6% for each of 5 years, ignoring compounding, you're getting 30%, right? Everyone will agree with that. Okay, and then we can look at the 2-year loan, right? So the 2-year loan, Okay, that's going to be 4% and 4%, so that's 8. Right? And then we've got to earn the rest of it in that last 3 years. Well, let's see. If I take 30, right, that's my total return, ignoring compounding for the 5-year investment, and I subtract off the 8 that I can lock in today with the spot rate, okay, that equals 22, but that's over the entire period, right? So over this period, you know, the 3rd year, 4th year, and 5th year, over that period, I got to earn 22%. How much does that mean I have to earn each year? Well, if I take 22 and divide it by 3, what I get is 7.33%. And notice that we're off at the 100th place, right? So just using the linear approximation, 5 years, 30%, you go back, subtract off 8, divide, get what's left over, divide it by the number of years. Well, from 7.35 to 7.33, we're pretty close, right? Okay, I think this is going to be discouraging. We're only 7 slides into this reading, and we got really thick, really quick, and it's not actually going to let up much for a little while. But understanding what we're doing here is important. All right, so it's just to be, and all we're doing is moving back and forth between spot and forward rates. All right, so getting the spot rate curve to begin with, we are going to talk about that. I don't think that's as important, but being able to manipulate spot and forward rates like we see here is really important. And as a safety net, okay, I want you to remember this little linear approximation. Right, just add them all up, forget compounding, and see how that works. All right, so going between spot and forward rates, so the notation here is what bothers everybody. So if you get a handle on the notation, I think you'll find that it works pretty well. All right, so I told you earlier you're going to see a really complex picture. All this really says, okay, is this is the yield curve, then this is the spot rate curve, and then the forward curve is going to have to be even above that. So this is going to be F, lowercase f. This is going to be S, and this is going to be yields. And if we did it the other way, okay, this is time against percent, I guess we'll call it, time against percent. Well, if we had a downward sloping yield curve, right, then the spot rate curve would be downward sloping at a greater rate, and the forward rate curve would be downward sloping at even a rate greater than that. All right? So, and it has to be because, if the spot rate's going up, then you've got to have this expectation of really higher interest rates in that stub period at the end of the curve, if you want to think of it that way. So I think this is a relatively confusing graph. I mean, I look at it long enough and I go, aha, but this is all that they're really trying to get across. Okay? It's going to be the forward rate. If the yield curve's upward sloping, the forward rates are going to be really high, and the spot rates will be in the middle. If it's downward sloping, the forward rates are going to be really downward sloping fast, okay, and the spot rates will again be in the middle. The other way to think of that is spot rates are in the middle. All right? Okay, what about par rates? So par rate is the yield to maturity for a bond trading at par. So if we were to force bonds to trade at par, what would be the par rate? And then we can look at it for different curves. So we can get a par rate is going to be equal to the coupon rate, right? And then we can, from that, build a par curve, right? So for a bond with a single cash flow remaining, i.e. the last coupon and the principal payment, then the par rate and the spot rate have to be the same. So when you get to the end, you're only 1 year away from the bond. We're ignoring 6-month returns here, 6-month bonds. So when you're only 1 year away, okay, there's no interim cash flows. Well, the spot rate and the par rate have to be the same. Typically, we get these par rates are used to generate spot rates via bootstrapping. All right. Now, what is bootstrapping? Bootstrapping is a fairly common procedure that you use in a lot of different areas. I have a good friend that works in actually X-ray stuff, and they have a bootstrapping process there. And it's the same thing, or it's used the same way, used a lot in statistics, used here. And all this says is, if you have the first one, you can get the second one. And if you have the first 2, then you can get the third one. And if you have the first 3, then you can get the fourth one. So that's what bootstrapping is. So you got 1, that gives you the ability to get 2. Once you have 2, you can get 3. Once you have 3, you can get 4. So we can bootstrap a spot rate curve. I don't think this is quite as important, but nonetheless, here's what's going on. So we have a 1 year, 2 year, and 3 year par rate curves are 3, 4, and 5%. So that would be the interest, the yields on a 1 year bond that makes the value of the bond equal to its par value is 3%, okay? 4% for a 2-year bond and 5% for a 3-year bond, right? So what we want to do is we want to bootstrap S1, S2, and S3. So S1 for a 1-year bond, well, let's see, if it's a 1-year bond, 0, 1, we're going to get, $1,000 plus the return of principal. Well, the yield and the spot rate are the same by definition on a 0 coupon bond. So the 1-year spot rate is simply 3%. Right, so it's going to be, we're going to get 103 here. We want to bring it back at some rate that's going to give us 100. Well, that has to be, 3%. Well, that's the same as a spot rate. A spot rate is a rate that we use to discount a single cash flow in the future back to today. This is a single cash flow, the return of principal, final interest payment. So we discount that back to today to get 100. All right. So the spot rate and the yield for the first one is the same, and that's why we can do bootstrapping. We always know the first one. We always know the first spot rate, it's just the yield on a short-term bond, and then we can find the second, and once we have 1 and 2, we can find 3 and so forth. So here's the point. If you're looking at a 2-year bond, well, if you're looking at a 2-year bond, we have a 1-year bond that has a cash flow here, 103, that we're going to discount at 3%, right? That's supposed to be an at 3%. And then we have another bond that has a cash flow at time 1 and a cash flow at time 2. It's going to have a $4 cash flow here and 104 here. But if we're using the yield curve, then we're going to discount this at 4%, right? Now, why would we discount a cash flow from, let's say, the U.S. government at time 1 at 3%, and then in another instrument, discount a cash flow at time 1 from the U.S. government at 4%? We're discounting the cash flows at the same time from the same issuer at the same percent. Well, the whole idea behind spot rates is to say, look, let's take that first cash flow. We know the 1-year spot rate is 3%, so let's discount that back at 3%, and then we're going to take that second cash flow, 104, and discount it at something that's going to be, we'll have to square it because we're going to have 2 years, that's going to force the bond to have a value of 100. Okay, so if we did it at 4%, that would bring it back, but we know that this is not 4% because this has to be 3% because we already got the 1-year spot rate. So notice here that we know everything in this equation except S2. So we know the value of the bond, we know the cash flows, we know the 1-year spot rate. So all we're doing here is solving for S2, and of course it turns out to be a little higher than 4%. You should have seen that coming. Why? Because if we discounted in 4% first cash flow, 4% second cash flow, we'd get $100. Okay? But if we discount the first cash flow at less than 4%, 3%, then we're going to have to discount the final cash flow at a little more than 4% in order to get us back to $100. So in this case, we're going to have a spot rate at for time 2 of 4.02. So 3, 4.02. Notice it's upward sloping at a little greater rate. And then we could take and do the same thing for the third one, but I'm not going to walk all the way through it. And we'd see that it is still a little higher still, right? So of 5.069%. So bootstrapping, if you know the first one, which you always do because it's any bond, when you're one period away from maturity, okay, you're going to have a 0 coupon bond, and the yield and the spot rate have to be the same. So we know the first one, then we can find the first 2. Once we know the first 2, we can find the third one, and we could keep doing this out through 30-year bonds if we were real gluttons for punishment. All right. So bootstrapping here. I don't want you to get bogged down in bootstrapping. So if you are struggling here to understand, let's move back and forth between forward and spot rates. Okay, that's the main thing. This is how we get spot rates to begin with. We get them in this bootstrapping process. Okay, but I think that this is less important, at least right now, if you're struggling, than being able to move back and forth between forward and spot rates. Okay, so don't let this get you down. Right, forward spot rate relationships. So return on a bond over 1 year is always going to be equal to the 1-year risk-free rate if spot rates develop as predicted. So if this were actually to apply, we would always earn this risk-free rate. An active portfolio manager, however, is going to try to outperform. That's what active managers do. They try to outperform the market by predicting how the future spot rates are going to differ from those that are predicted by the current forward curve. So we have a forward curve. Well, do you really think they're going to go up that much? Okay, or are they going to go up more than that? They're going to go up less than that? Well, if you have superior ability to predict that, then you're going to be able to earn a superior return on your fixed income portfolio. So if the future spot rates are going to be below the current forward rate curve, okay, the current forward rates predicted by the relationship between forward and spot rates, okay, then you can earn a positive alpha and you're going to get a return greater than this 1-year risk-free rate. Now, if that doesn't make sense, let's think about what we're saying here, okay? So this is a procedure called writing the yield curve. So writing the yield curve says, look, let's simply buy bonds longer than our holding period, and then we'll sell them when our holding period is over. Why is that important? Well, let's suppose that we have a 5-year holding period. Let's assume that we have a 3-year holding period. So we've got bonds here we've got 1, 2, 3, 4, and 5. And if we're looking at the yield curve, we see that 5-year bonds have, we're going to call it a 7% yield, and then 3-year bonds have a 5% yield, and 2-year bonds have a 4% yield. All right? Everybody okay with that? All right, so this 5-year bond has a yield to maturity of 7%. The 3-year bond has a 5% return, and the 2-year bond has a 4% return. Now, if we have a 3-year holding period, right, so we need to invest money for 3 years, what we could do is we could go out and we could buy this 3-year bond, okay, and we could earn 5%. So we'd buy a bond, right, and we're going to hold it for 3 years. We're going to earn 5 and 5 and 5, and that's going to be 15%. Everyone's okay with that? All right, now, what if instead, though, we buy the longer-term bond? We buy a 5-year bond, but we only hold it for 3 years. Okay, well, if we buy the 5-year bond, okay, then we're going to hold it for 3 years. How much are we earning each year? Well, what we're earning is, 7%, 7%, 7%, okay? And what happens to the bond as we come down the yield curve? Well, if we ride down the yield curve, we bought this bond to yield 7%, but when we sell it, it's a 2-year bond, right? You assume the yield curve was constant here, okay, so when we sell it, it has a yield of 4%. Well, what happens if the required return on a bond falls? Well, then the price goes up, right? So that's the old pencil trick. When it's level, okay, this side's pointing to interest rates. When it's level, it's pointing to the coupon. This side's pointing to prices. When it's level, it's pointing to its par value of $1,000 or $100. Well, if interest rates fall, the value of the bond goes up, right? If interest rates go up, the value of the bond goes down. Okay, so what happens is we buy a 5-year bond and we hold it for 3 years. Buy a 5-year bond, hold it for 3 years. It's a 2-year bond. Well, if the 2-year yield to maturity is 4%, then we've earned the higher rate, and when we sell the bond, we bought it with a 7% coupon, let's say, and we get to sell it at a premium. So we pick up the higher yield of the longer-term bond, and we get a capital gain when we sell it. That is riding the yield curve. Now, that assumes that the forward rates don't evolve like the current yield curve would suggest, because what should be happening here is this is the yield curve. Remember, the yield curve's like this, spot rate curve's like this, and then the forward curve's like this. Well, by the time we get to a 2-year bond, 2-year interest rates ought to be so high that the capital loss, so we have to bear when we sell it, would wipe out the fact that we had earned a higher return in the interim. Now, that's clearly proven not to be the case. Pure expectations theory doesn't hold. But nonetheless, there's some reasons that we have to use it anyway when we're pricing things like forward rate agreements and that sort of stuff, because there's arbitrage opportunities if you don't. Anyway, so this is riding the yield curve, and this is what an active manager, an example of what an active manager might do if they think that that forward rate curve is too steep. It's not really going to evolve that way. Well, then you buy a longer term bond and hold it till your holding period is over, and then you sell it. But remember, the longer the bond, the greater the price risk, right? So the greater the price risk, well, if interest rates change, if interest rates were to move up, then the value of your bond is going to fall more. So it's not like this is a risk-free maneuver. Okay? All right, so riding the yield curve, something interesting enough to keep an eye on going into the exam. Let's talk a little bit about swap rates, curves, spreads, that type of thing, just some general definitions. So the swap spread, this is the amount a fixed rate payer side of an interest rate swap, the amount by which the fixed rate payer side of an interest rate swap exceeds a yield on a government bond with the same maturity. So we're going to go out and we're going to say, well, okay, what's the swap spread sub 5? Okay, we're going to go out and get the swap rate for a 5-year swap, and we're going to compare it to a treasury with 5 years to maturity. Okay, that's the swap spread. So if this is 4, this is 2.5, then the swap spread is going to be 1.5%. So this is, and the idea here is that the swap spread is not risk-free. So this is risk-free. As this gets wider, it says something about what's going on with the amount of risk in the economy. So the yield curve, typically based on Treasury securities. So when I do this, time against yield, and I do that, the way we calculate or normally present yield curves is based on U.S. government Treasury securities. The swap rate curve, the yield curve is based on a series of fixed rate quotes on interest rate swaps. Okay, and the point here is, again, that this is increasingly preferred as a benchmark. So the swap rate curve is preferred as a benchmark because it's not affected by government regulation. Okay, so it's swaps are offshore, right? So there's no one market that regulates it. They're more comparable across countries, and there's more maturity quotes, so we don't have to do all that interpolation in the middle. So swap rate curve. We're going to look at several curves here. I think the swap rate curve is the one that I would be most keen to pay attention to. So the I-spread is the difference between a bond yield and the swap fixed rate, same maturity. So it may be that the swap fixed rate has to be interpolated, and I'll show you a quick example of interpolation, but I don't want you to get bogged down on it. So, and what we're doing is the I-spread is telling us something about the credit risk relative to LIBOR. So remember, this is based on LIBOR, so it's not risk-free. The bond yield, if the bond has a yield of 5% and the swap fixed rate is 3%, well, that gives us a 200 basis point spread. If that spread gets wider relative to LIBOR, then we've seen something happen with the relative risk between those two instruments, between LIBOR, or swaps, and the bond's yield. So that's called the I-spread, and it's just the bond yield minus the swap fixed rate. Okay? So the interpolation thing here, again, I don't want you to get too bogged down, but if we have a 2-year and a 2.5-year spot rate, a 2-year and a 2.5-year swap fixed rate. So we can enter a 2-year swap or a 2.5-year swap, and the rates are 2 and 2.3. But then we want to know what the 2.2-year equivalent would be, right? So we want to interpolate a swap fixed rate for a 2.2-year fixed rate swap. Well, here's the thing to remember. We're going to start with the shorter term rate. So we're going to start with 2.0, and then we're going to add something to it that is based on the spread between those two, right? So the spread is 0.3. Well, let's see, it's 0.3, but that reflects, going from 2 to 2.5. What we're doing is going from 2 to 2.2, so we don't want to add 0.3 here, right? 0.3 would be, just give us back to 2.3, and that would be for 2.5 years. What we want to do is add enough to reflect the fact that this 0.3 spread is earned over 6 months, going from 2 to 2.5 years. We only want to go 0.2 years, right? So we're going to start with 2, and we're going to say, oh, here's the spread. This is going to be the 0.03, and then we need to say we want 0.2 as a function of, or as a portion of, 0.5 years, right? So 0.2 over 0.5, okay, well, whatever percentage that is, times 0.03, this is what we're adding to the shorter term rate to get this 2.12. All right, so interpolation, I can see this showing up on the exam because somebody's getting, we'll say, retentive. Anyway, but this is how we would do it. And again, we're saying, look, we have something that goes from 2 to 2.5, so we know that's 2% and 2.3%. Well, this is a 0.03 change here, right? But we want to go from 2 to 2.2. Right? 2.2. We don't want to go all this way over here, right? So we need the portion of this 0.03. Think of it as, going up the function. Okay? We need the portion of this 0.03 that would have been reflective of the change if he just come out 0.2 years instead of 0.5 years. So we're going to have 0.5 in the denominator. That's down here. We're going to have 0.2 in the numerator, and we're going to multiply that by the 0.03. That's going to be the amount that we add to the shorter term rate. Okay? All right, again, this is sort of like bootstrapping, good thing to know, but this is not, bootstrapping and interpolation are not going to have big implications for your understanding of everything else. They can certainly show up on the exam. Those two things are not going to have lots of fingers. Understanding spot and forward rates, those will. Okay, the Z-spread. Z-spread is really important. We did this at level 1. So the Z-spread is the spread that we add to each spot rate on the default free spot rate curve to make the present value of a bond's cash flows equal to the bond's market price It's a constant spread that we add to each of the default-free rates on the spot curve, right? So it's a spread over the entire curve. So let's think of it this way. So we go out and we bootstrap out a spot rate curve, right? So this is going to be spot rates, and I get these rates, okay? So whatever they are, and then I go and I say, okay, I want to find the price of my AA bond. So the price of my AA bond, I take all the cash flows, take the rates from the spot rate curve, and I end up calculating a price. I'll put prime here for my calculation, and I get a price of $943. Okay, that's great, except for what I then did is, to mess myself up, I went and looked at the market price, the price in the market of this bond, and it was I'm going to call it $31, not $931. Well, when I calculated the price using the spot rate curve, I got 943. The actual price in the newspaper is 931. Why is that the case? Okay, well, remember that this is sometimes called the theoretical spot rate curve for treasuries, right? So these are default-free rates. If I take my default-free rates and discount the cash flows in my risky AA bond, well, I'm using too small a discount rate, so I'm going to get a price that's too high. I'm going to go through a trial and error process, but let's say that what I do is I take and I add, okay, 50 basis points to each one of these spot rates. Okay, I add 50 basis points, and then I'm going to go in and do it again. I'm going to calculate the price of my AA bond, given that I have my spot rates, and I'm adding 50 basis points to them, and what I get is $931. Okay? Well, now, so I took the spot rates plus 50 basis points, right? BP. So the spot rates for each spot rate, I added 50 basis points, and now I've forced the market price and the model price to be the same. Well, that 50 basis points is the Z spread. Okay? It's the constant spread that I add to every spot rate on the theoretical spot rate curve for treasuries that forces the market price to be equal to the model price. And what that says is, look, for accepting the additional risk associated with a AA bond relative to a treasury, okay, I earn 50 basis points more in return. So that's my compensation for bearing the credit risk, right? So the Z spread, I would make sure I had a handle on what was going on with the Z spread. Okay, a little bit more on it. The Z stands for zero volatility, and just means that assumes there's no volatility in interest rates. And the reason that's important is because the Z spread works fine, okay, if you were talking about a bond that doesn't have any embedded options, okay, but it is not appropriate, okay, not appropriate for a bond that has embedded options, because then as interest rates change, there is interest rate volatility. Well, if there's interest rate volatility, that's going to change the value of the bond, right? But we don't have to worry about that if we're talking about a bond without embedded options. The value of the bond is going to change, but it's going to change in accordance with the change in interest rates. If we're talking about a bond that has embedded options, which we're going to get to later, then not only does the discount rate change, but the cash flows change. In other words, if interest rates go down, the bond gets called away from us. So we can use the Z spread for an option-free bond. Okay, if we're going to have any other type of bond, any bond with any embedded option, then we're going to have to use something else, and that something else in our world is going to be the OAS, the option-adjusted spread, but we're going to talk about that later. All right? So Z-spread, something I think that you want to have a handle on. Okay, so let's think in terms of TED spread. So the TED spread is the spread between the T-bill and the euro-dollar rates. So T is in T-bill, ED, that's the euro-dollar ticker. So the difference in interest rates between loans on LIBOR, okay, so that's a LIBOR-based, the euro-dollar is a LIBOR-based instrument, okay, and the rate on T-bills. So if you get a 3-month LIBOR is 0.33, the 3-month T-bill is 0.03, then the TED spread is going to be just this 30 basis points. So 30 basis points or 0.3%. And this is going to tell us something about the risk level in the banks. So it's seen as an indicator of the level of credit risk in the economy. So if it gets wider, credit risk is getting higher. So T-bills are risk-free. LIBOR, of course, reflects the risk of lending from bank to bank. So a rising TED spread suggests that banks are increasingly likely to default on bonds, okay, on their loans, excuse me. So the banks are increasingly likely to default as the TED spread gets wide. Okay? The market's demanding a higher return. Okay, so that's got to be the issue. And then maybe the bigger deal is that this is going to suggest we're going to have falling liquidity in the economy. So a rising TED spread suggests falling liquidity, and a shrinking TED spread suggests enhanced liquidity or easier money, all right, going forward. So what about the LIBOR OIS spread? Okay, so the OIS is the overnight index swap. We don't worry about calculations here, but it's roughly equal to the Fed funds rate. It has very little counterparty risk here. So if we take LIBOR minus the OIS spread, okay, that's just the amount that LIBOR exceeds the OIS rate, and it's also a measure of credit risk credit risk in, I guess, just like the TED spread was. So in terms of banks and the overall well-being of the banking system, and concomitant with that is the notion of how secure is the liquidity, right? So if we get a rising spread here, LIBOR is spreading relative to the OIS, okay, well then we're going to see that that's going to have implications for the bank, the less sound the banking system, and the greater the potential problems with liquidity in the economy. Now let's look at the theories that we have for understanding the term structure of interest rates. Another way to think about that is the theories behind why the yield curve looks the way it does. So what we would normally see, if we looked at time against yield to maturity, right, is we would see this upward sloping relationship, and that says that, you buy a short maturity bond, you get a lower yield. If you buy a long maturity bond, you get a higher yield. And that would make perfect sense based on the fact that longer-term bonds have more price risk, right? So, the longer the duration, for a given change in interest rates, you're going to get more change in the value of the bond. So more price risk in longer-term bonds, just like we talked about at level 1. If it was always the case that we saw this upward-sloping yield curve, then that would be the end of the story. But there are times when we see a yield curve that is flat, and other times when we even see the yield curve that is downward-sloping. So the problem we're facing here is we need to understand why the yield curve is normally upward sloping, but at times also is flat and at times is downward sloping. And also, we would also think about, well, it could be upward sloping like this, and it could also be upward sloping like that, right? So both of those are upward. What about the curvature? So how do we come to understand the different shapes of the yield curve, both in terms of slope, positive or negative, and then how humped it is, or those types of things, right? So we have a number of theories on this, and if you lose your freaking mind and decide to go get a PhD in finance or economics, bring your math goggles, because there's a lot of math that applies to this. Luckily, we're just going to talk about sort of the implications of it, and what I want you to do is I want you to get to where you can talk about this one to yourself for about 90 seconds. And then these others, if you can talk to yourself for about 30 seconds each, then you know what you need to know. So we have 5 theories: unbiased expectations, also sometimes called pure expectations, right? So I'll write the word pure here. So pure expectations is what we've called it elsewhere in the curriculum. Local expectations, which is going to be a derivative of number 1. Liquidity preference, which is sometimes called biased expectations. So notice this is unbiased or pure. Down here we would have biased expectations. So all these first 3 are really related. And then we have these other 2 things, segmented market and preferred habitat, which are kind of anti-theory theories. And I'll tell you what I mean by that in just a moment. So let's spend a little bit of time talking about pure expectations or unbiased expectations, and then we'll just work through the list, right? So when we're talking about pure expectations here, what this says is that investors' expectations determine the shape of the interest rate term structure. So when we see that interest rates are going, up like this, okay, that says that, according to pure expectations, it says that investors expect interest rates to be higher in the future. So you can think of this as like a pointer, right? So if it's upward sloping, then interest rates are going to be higher. Of course, this is time against yield still. So if it were flat, that would say, okay, it's pointing to flat. That means no change in interest rates. And if it's downward sloping, that would mean interest rates were going to fall. Okay, so these forward rates are just the expected future, or a function of these expected future spot rates. And it's actually this theory that drives this relationship between forward and spot rates. All right? So, and the implication here is, 1, that we have the yield curve could be interpreted as a pointer. What's happening in interest rates? Upward sloping, flat, no change. Downward sloping, they're going to go down. But that's also where we got this idea that, look, if you have a 2-year bond, okay, that has has a 4% return here and a 4% return here, then you're going to earn without without considering compounding, which we would if we wanted to be really, really accurate, we're going to get 8%, right? Well, what if we had a 1-year bond we could buy today at 3%, and when that matured, we could then go and buy another 1-year bond at some rate? Well, that 1-year bond in the future, that rate that we get is the forward rate. It's the 1-year forward rate 1 year from today. So it's the F1, 1. Well, what does it have to be? Well, according to pure expectations, we earn 8% up here. Then we're going to earn 8% here too. So that means that this has to be something very close to 5%, right? So this is what gives us this relationship between spot rates and forward rates, okay, is this pure expectations theory. And while we know this doesn't work, okay, if we price, there are securities that if we price any other way lead to arbitrage opportunities. If we use this, then there's no arbitrage opportunity. So, so we end up actually employing this a lot, right? So unbiased expectations. Now, the problem with that is this story that I told, going over 2 years, I could also tell about, well, let's get a 15-year security and then versus a, I don't know, an 8-year and a 7-year or something like that. Okay, well, what we get to local expectations, what that says is, yeah, this risk neutrality thing is probably okay over very short-term stuff. So if we were looking at, I don't know, 1 month and 2 months, then maybe this would work. But as you get longer and longer, the risk associated with longer-term bonds becomes part of the function, right? So if you would say, well, I'm going to buy this 2-year bond, I'm going to get 4% and 4% for a total of 8. Well, if I buy a 1-year bond where I'm getting 3, well, I'm taking less risk, so maybe I'm only going to get, 3.8 here, because now I have less risk in the bond. So in other words, if I'm taking less risk, I should get a lower return. Right? Make sense? So anyway, the point here is that if we go to really short periods of time, then maybe this pure expectations holds. That's why we call it local. The other way to address that would be short-term expectations. Okay? And so we have pure expectations, which would apply over the entire term structure. Local, which applies only to the short end. Okay? Neither one of them work. Okay? So it's not a question of whether we can actually predict what interest rates are going to be in the future. But the idea is, at least with local expectations, we're a little closer. All right? Liquidity preference, this is also sometimes called biased expectations. And what this says is that when we look at the term structure, looking at time again against yield, what we observe in the yield curve is actually 2 things. Okay, one of them is the expectations, okay, that we would get from market participants. But the other is the liquidity premium. Okay? So if I buy a short-term bond, then I don't have any risk. Right? So if I'm way down here, but if I buy a long-term bond, I need expectation, plus I need to be compensated for the additional risk. So what's observable is both the expectations and a liquidity premium that's related to maturity. So it's not the case that we can observe expectations, but if we could, maybe expectations would look like this. So this is just expectations by themselves. So down here we have almost no liquidity premium, and here we have a big one. So the point here is that we have expectations. That's one of the determinants of the shape of the yield curve. Then we have to add a premium that's related to maturity. So if we have an upward sloping yield curve like we see here, well, what does that say about expectations? Well, expectations could be upward sloping also. Okay, expectations could be flat, right, and we just have a really big yield premium. Or it could even be that expectations were for, a decreasing interest rates, but we have a monstrous liquidity premium. Right? So we don't really know what expectations are if we have an upward sloping yield curve. But if we have, by chance, okay, we have a flat or a downward sloping yield curve, if that's expectations plus a liquidity premium, since we know that the liquidity premium is associated with maturity, okay, then we know that the expectations would have to be downward sloping. So upward sloping yield curve, then expectations can be upward sloping, flat, or downward sloping. But a flat yield curve or a negatively sloped yield curve, then we know expectations have to have a negative sign. All right? So it's just a matter of adding this liquidity premium that is related to maturity. Bigger, longer maturity, higher liquidity premium. All right? So that's the first 3. Not too bad. Okay, so let's think about segmented markets. Segmented markets and preferred habitat are actually pretty similar, at least in discussion. The mathematics that drives them is quite different. Okay, but we don't have to worry about that. And I would refer to these as sort of anti-theory theories, because what we're looking at in especially pure expectations and also, I guess, in liquidity preference, is we're looking at a yield curve. It's got 30 or 50 years on it, and we're trying to explain it all in one grand equation. Well, what segmented market says is, look, when we look at the yield curve, this is time against yield, we have some people that, or some entities that because of either regulation or economics need to play in the short end of the curve. Maybe that's banks, right? And then we have some that need to play in the medium segment of the curve. That may be property and casualty companies. And then we have others that want to play in the long end of the curve. That's pension funds or life insurance or something like that. And the point here with segmented markets is, I'm going to draw lines here. All right? So we're going to have a little supply and demand equation that's going to determine interest rates here, and then it's going to determine interest rates here, and it's going to determine interest rates here. So with expectations, we're trying to look at the entire curve, the entire maturity spectrum at one time. What this says is, and it's no reason to assume there's 3 segments, there could be 33, but 3 segments for ease of discussion, okay, that each of these segments have interest rates that are determined independently, so we could get any shape in the yield curve, right? I mean, depending on the demand for funds and the people that are there to loan funds in that particular segment. It could go down and back up, you know, it could be flat, whatever it is, so we can explain any shape of the yield curve with segmented markets. All right? So the last one is preferred habitat, and preferred habitat says, well, if we're looking at time, we have some people that want to play short and some people that want to play medium and some people that want to play long, looking against yields. Okay? But the difference is, rather than drawing those fixed lines, what I could do is draw dashed lines. So now, rather than having segmented markets where people have to play short and have to play medium and have to play long, they have a preferred place. They prefer to be medium, they prefer to be long, they prefer to be short. So if interest rates get high here relative to the other 2 segments, high in the middle, well, maybe those people that are loaning money short might be induced to come and loan money longer term because the yield difference gets so big. And those people that are loaning money longer term might take, might make shorter term loans because they can pick up more yield. Or you can think of it from the borrower's side as well. So if borrowing costs are high here, you may switch down. Borrowing costs are high here, you may go longer. So we got 2 sides of this. Got to have someone borrowing and someone lending. Either way, in this case, we allow movement between the segments. So the only difference between segmented markets, that's where we drew straight lines, and preferred habitat is we allow people to move between the lines. In either case, we can explain any shape of the yield curve. All right? So not too bad. Pure expectations, that's thinking of this idea of the shape of the yield curve as a pointer. Local expectation says, oh, that only works short term. Doesn't really work. Then liquidity preference, we just add a liquidity premium that is related to maturity. And then for segmented market and preferred habitat, we're just going to draw lines, and the question is, are they dashed lines or are they solid lines? All right? So I don't think you need to get bogged down here. You don't need to write a book. Now, that's sort of yield curve theories. Let's look at what they're calling modern theories here, or maybe models. And these are things that we can plug into interest rate models that we're going to use to value bonds, right? So we're not just talking about why the yield curve looks the way it does. We're actually going to take these and model yield curves in order to come up with the value of a bond, for instance. So we have 3 models here. We have a Vasicek model, Cox, Ingersoll, and Ross CIR model, and then we have the Ho-Lee model. So one of my senior professors was a co-author of Ho, and so I had to work with the Ho-Lee model all the time in my PhD program, so I kind of get a twitch when I see it. But anyway, so it's not, while these are going to look a little weird to you, okay, I don't think this is someplace you need to get bogged down. What you need to do is just understand what they're saying, understand the differences between them, and then move on. All right? So this is going to be fairly straightforward. So this is the Vasicek model. And what it's saying here is that this DR, so D just means change. We could write this as the change in interest rates. Okay, D just means we're using continuous time, so a little calculus here, is going to be equal to this, this first function, which, so we're looking at A times B minus R times dt. dt is a small increment of time. So we're using calculus, so we're letting the time increments approach 0. Right, so this is a small increment of time, okay, and this is going to be the change in rates over that period of time. Well, what's A, B, and R? So R is going to be the mean reverting level of interest rates. So let's say that R is equal to 3%. So R is equal to 3%, and then we would see that currently interest rates are 5%. So B is the long run rate, and R is the current rate. So if we have a long run rate of 5%, okay, so that's what we think is going to be the long run mean reverting level. Current rates are 3%. Well, 5 minus 3 is equal to 2. right? So that says we're 2% away from our mean reverting level. Well, the question is, well, if we're 2% off, okay, is our next move going to be 2%? So we're going to see interest rates increase. So is the change in interest rates going to equal 2% because we're 2% away? Well, no, we're not expecting to do all that in one step. So the A here is just an adjustment factor. If we're 2% away, maybe we're going to think of that as adjusting over 10 periods. So maybe we're going to take that 2% and multiply it by, 0.1. So we're adjusting over 10 periods. So we would say it's going to be 0.2% would be our deterministic part of the change in interest rates. So dt, again, this is what's going to happen over a small increment of time. All right, this is great, but what happens when we get to interest rates of 5%? Well, when we get 5 as our mean reverting level and interest rates are 5% in the economy, well, 5 minus 5 is 0. Okay, so it doesn't matter what sort of time increment we get. It doesn't matter what our A is because we're multiplying by 0. So it would get us to a 5% level and then it would stay there forever. Interest rates would be constant. That would be great, right? Okay, well, with this deterministic portion, okay, that's what we would expect to have happen in a mean reverting model, right? Then we're adding this thing, the stochastic term. I like to refer to it as a perturbation term. So this is something that is going to be, dz. It's going to be measured over the same time period, dt, and it's just going to it's going to be a function of the standard deviation of interest rates. So you can think of the standard deviation of interest rates as being, interest rate change is going to be centered at 0. Okay, and it looks like this, right? So we can sometimes draw a negative perturbation, sometimes draw a positive perturbation, okay, and that's going to be something we add to it, right? So if we take A, whatever that is, times 5 minus 3, it's 2%, and then we're going to add this other term, okay, and I'm just going to call it P for perturbation. Well, that is going to be what our change in interest rates are. So it's just the deterministic portion, that is the migration towards the mean, and then this perturbation that can be positive or can be negative. Right? So this is fairly easy. We have a mean reverting portion here in the middle. That's the deterministic portion. And then this random disturbance term that is going to keep things lively. That's the Vazicek model. Now, what's the problem with that? Well, the problem is that if interest rates were to get really low and we get a negative draw out of this perturbation term, then we could end up with rates that were, minus 5% or something like that, and we really don't like negative interest rates. So we can move to the CIR model, and what CIR do is exactly the same thing on the front end. The deterministic term is exactly the same, but we're going to take the standard deviation of interest rates, and we're going to multiply it by the square root of R. That's current rates. So if current rates are 5%, so the standard deviation times 0.05, okay, well, that would tell us what the perturbation term would be. But the point is, as interest rates approach 0, well, the square root of 0 is still 0. So this won't allow us to keep going negative, okay, as we get down close to 0. So the deterministic term is the same. Okay, but the improvement over the Vazicek model is in the stochastic term or the perturbation term at the end, and it won't allow interest rates to go negative. All right, so CIR and Vazicek, okay, the only difference is whether or not we're putting in this square root of R here. Okay, so those are the first two. Okay, let's see, Vazicek model, volatility doesn't increase with the level of interest rates. With CIR, volatility does relate to the current level of interest rates, and effectively what that does is prevent interest rates from becoming negative in our model. So interest rates could become negative up here in Vazicek. Good enough? Here's what I want you to know. I want you to know that it's a mean reverting, that the A is an adjustment term. So we've talked about this in terms of dividends and, less than complete adjustment in any one period. So we did it with dividends. We've done it with other things in the curriculum. So we're going to have this deterministic mean reverting portion, okay, but we also have to have this random disturbance. Otherwise, we would get to interest rates in a steady state, and we just say, oh, they're going to be the same forever now. That wouldn't be a very good model of interest rates. So Vazicek CIR is going to be, the only difference is, does the perturbation term, does the volatility change with the level of interest rates? As interest rates get higher, does volatility get higher? Well, they do in CIR, and they get lower as interest rates get lower, and that prevents interest rates from becoming negative. Right, so one more. This is looking at the change in interest rates again. So here we have this theta dt, and this is just a time-dependent drift term, and it has to be calibrated using market prices. So you got to go in and say, well, what are interest rates now? And you're going to have to calibrate this, and you're going to get that from the current term structure. Then once you do that, so you're going to find this DT, right, or this, excuse me, the theta. Then you can use this to price zero coupon bonds and determine a spot rate curve. This is going to produce a normal distribution of rates, right? And what this allows us to do is develop things or improve on, well, at least alter the binomial interest rate models, right? So this is just something that has to be calibrated from what market rates look like today, and this is just another disturbance term that allows us to have put some uncertainty into those interest rates. So this looks a lot like the other two. Okay, we got theta, which isn't a function of mean reversion; it's just a function of time variation. Okay, and one of the big changes here is that you get a normal distribution of rates if you're using the Ho-Lee model. Okay. Something you need to worry about, I think you need to be able to distinguish between Vazicek, CIR, and Ho-Lee. Okay, so my thinking is that what I would focus most on is Vazicek versus CIR because there's more intuition there about mean reversion and perturbation, that sort of thing. This is really the same thing, but they don't give us much information on how to do this calibration and the time variation in theta. So the intuition here is not as easy. It's mathematically it's elegant, but we don't have the math in the curriculum. So I think you ought to know what it is, but I would lean on the other two and know this one basically what it's saying. If you know this slide, I think you got it down. All right. Okay, yield curve shifts. And so this is going to be an important topic, and it's going to lead us into something that I think is relatively important. So we already reviewed this thing called duration at level 1, right? So we said the duration of a bond was equal to, we calculated it to be, 5.5 or something like that. So the duration is 5.5. Remember, what that tells us is it's the approximate percentage price change for a 1% change in yields, right? So if we're looking at this bond, if interest rates go up by 1%, then the value of this bond is going to go down by 5.5%. If interest rates were to go down by 1%, okay, then the price of the bond is going to go up by 5.5%, right? So inverse relationship between prices and yields. So the duration is just the approximate percentage price change for a 1 percentage point change in yields. Okay? Now, I'm going to come back to that in a moment, but when we did duration, the assumption is that we're working here. That is, we have a parallel shift in interest rates. All interest rates change by the same amount. So you could have, a curved yield curve, and all this is saying is that within the tolerances of my artistic ability, the shape of the curve before the change and after the change is the same. So interest rates moved up, but they moved up by the same amount, short, medium, and long. That's a parallel shift in interest rates. So if we have a parallel shift in interest rates, duration is going to do a pretty good job of explaining the change in the value of the bond. The trouble is we also have changes in steepness. We have little change here and a big change here. So the curve steepened, so there's a parallel element plus a steepening element. And we can also have this change in the curvature of the bond. So here it's not very curved. Here it's much more curved. Okay, well, we can see that, medium-term rates didn't increase too much, but long-term and short-term increased by more. So there was a parallel shift, maybe a shift in steepness, and a shift in curvature. So the point is we have parallel, non-parallel with respect to steepness, and non-parallel with respect to curvature happening at the same time. And to the extent that either of these two are significant, then the price change predicted by duration is going to erode or be less, it can be degraded, right? So our prediction is going to become worse and worse as we see steepness changes or curvature changes. Okay? So how do we deal with that? Well, we already know duration. So remember that we've got duration. There's a formula for it. You'll probably want to put that on your formula sheet. I'm not going to worry about it here. But there's also what I call the duration impact formula. Okay? And that's going to simply say that I want to take minus duration. Okay, so in the case of the example I was just doing, minus 5.5. Why minus? Well, that's the inverse relationship, right? So if rates go down, prices are going up. So minus duration times the change in yields, right? So if we had yields change by 0.5%, so the interest rates went up by 0.5%, so interest rates are going up, so prices are going down, so it's a negative times a positive. That's going to give us a negative number, right? So that would say that we're going to get, what, so interest rate, so the value of the bond is going to fall, or the value of the bond is going to change by minus 2.75%. Did I do that right? I think so. Anyway, so it's going to change by 2.75%. So if interest rates go up by 0.5% and the bond has a duration of 5.5, then we're going to see the value fall by 2.75. That's the duration impact formula. We also need a formula for duration. You'll want to make sure you get that out of your notes, but it's just going to look at the value when we shock rates up, when we shock rates down, that sort of thing. Okay, so the point here is that this is great for a parallel change in interest rates. Okay, but what happens if we have non-parallel changes? Well, then we're going to move to something called key rate duration. And we'll see that in just a moment. And we also have sort of an unspecified model where we can separately measure the sensitivity of the value of the bond to a parallel change, plus a steepness change, plus a curvature change. All right? So, and I don't think you need to worry about this one a lot, but I would worry a lot about this one, and I'd worry a lot about this one. All right? Okay, so effective duration, again, it measures the price risk for a small parallel shift in interest rates. The trouble is most yield curve shifts are non-parallel, so they can describe them as a parallel component plus a steepening or a flattening, or a parallel component plus, a curvature change. But the solution is to move to key rate duration, which gives us a way to measure the impact of a change in yield curve, of a non-parallel change in the yield curve, on the value of the bond or the bond portfolio. All right, so that's key rate duration. So it's a little more sophisticated, takes a little more doing, but it's used again to quantify the sensitivity to a non-parallel shift. Well, it sort of depends on how you're going to say this, right? So if you say key rate duration, then you're probably off on the wrong foot. Okay? If, on the other hand, you say key rate duration, well, then that's going to be a little more, better way to start your investigation of key rate duration. So what we're going to do is we're going to look at the yield curve, and instead of looking at the whole thing with duration, we're going to look at a spot rate curve, not the yield curve. Look at the spot rate curve. So this is going to be 1, 2, and it's going to come out here to 30 years, okay? And we're going to have all these spot rates, right? And duration is a measure of what would happen if we shifted all the spot rates up by 1% or all the spot rates down by 1%. Okay, that would be the interpretation of duration. But now, if we're talking about rate duration, we're not looking at all of these spot rates. We're looking just at a few key spot rates, right? So we're going to find the rate duration if we shock this interest rate up a little bit and then we shock the interest rate down. What happens to the value of the bond? If we're looking at the cash flow at time 2, we can discount a little higher rate, a little lower rate. Okay? We're also going to have to weight the bond by how much of the cash flows come at time 2. And in the end, what we're going to see is that we can take the rate duration, okay, and it's still going to have an inverse relationship. Increasing rates are going to drive down the value of the bond, times the change in yield for that particular spot rate. Okay, and then we can do it for a number of key rates. So this might be, the 2-year rate and the 5-year rate and, the 10-year rate and the 20-year rate or something like that. Okay, they're actually going to use either, I think it's 13 or 14 in standard analysis. Okay, but they're only going to use 3 or 4 on the exam. And it's just going to be the rate duration, okay, which is going to include the sensitivity of the bond, okay, to a change in the spot rate. And it's going to have to be weighted, okay? So, and you'll need to work some problems on that before you get into the exam, times a hypothesized change in that particular rate, in that particular spot rate. So, not particularly hard to use, okay? We're just taking our, I'm going to go backwards, okay, again. So we're going to take our duration impact formula right here that we've been using since level 1, minus duration times the change in yield, and now we're going to have minus the rate duration times the change in yields for a particular spot rate, and we're going to do that iteratively. We're going to do it several times to get different points on the spot rate curve, right? And that would allow us to say, hey, maybe the 2-year spot rate is going to go up by 10 basis points, the 5-year is going to go up by 40 basis points, and the 10-year is going to go down by 10 basis points. So we can have any hypothesized change in the yield curve, and we just look at those key spot rates as indicators of value. All right? So key rate duration, again, I don't think that's particularly bad. So sensitivity to level, steepness, and curvature movements. Well, what we could do is say, look, we can go in and use some statistical tools, and we can say when level of interest rates change, what happens to the bond, value of the bond. So this delta XL is a change in the level of interest rates. That's what the L stands for, level. Okay? We could also look at a change in steepness. Okay, so that would be a change in steepness, and a curvature change would be the change of x sub c, so change in curvature. So we're going to have short and long rates increase, intermediate rates don't change by as much, those types of things. And then we can plug into a model that looks like this. So the change in price over price, so that's going to be $5 over $100 or something like that, right? So the price, it's like a holding period return. And this D is going to be a sensitivity. Okay, and this sensitivity to level changes. This D is going to be a sensitivity to steepness changes, and this D is going to be a sensitivity to curvature changes. So, and we still have to figure out how to measure curvature, how to measure steepness, and how to measure level. Level's easy, it's just going to be the parallel shift. Okay, but these Ds we don't have to worry about measuring within the curriculum. So I don't know that this is really something we're going to apply, and I guess we could apply it. We could tell us this was 0.1 and this was 2, so we could multiply those things together. They could tell us this was 0.7 and this was 0.4, and we could multiply those things together, and we could do the same thing here. But at the end of the day, I think this is more a way of thinking about interest rates than it is actually coming in and making the changes. So we're going to have a sensitivity and then a measure of change for level, a sensitivity and a measure of change for steepness, and a sensitivity and a measure of change for curvature, just like we would for a regression equation, right? So we go back, we have beta 1 times x1 plus beta 2 times x2 and so forth. This looks the same. These are just sensitivities, just like the betas are sensitivities. All right? So again, that's not something that I think is particularly terrible. What about the maturity structure of yield curve volatility? Now that's a mouthful. Maturity structure of yield curve volatilities. And the point they're trying to make here is that, look, if you're looking at short-term rates down here, this is annualized volatility, short-term rates are very volatile. Okay? But if you look at long-term rates, okay, so this is 30 years, well, long-term rates are not nearly as volatile as short-term rates. So while the duration is higher here than it is here, right? Longer-term bonds have more price risk. Okay, well, if you really want to understand, interest rate risk, you've got to take duration, and you have to think of it in terms of, well, how much are rates actually going to change? For short-term bonds, we have low duration, but a high probability of change. Okay, for long-term bonds, we have a big duration, but a lower probability that there's going to be significant change. So we kind of have to balance those two factors when we're thinking about actual price volatility for a bond. So the yield structure and maturity structure of yield curve volatility, it shows this almost monotonic decreasing volatility as we increase maturity. Long-term bonds have lower volatility than short-term bonds. Longer bonds have lower interest rate volatility, not volatility necessarily. Wouldn't apply to price volatility. So maturity structure of the yield curve volatilities, again, so interest rate volatility is going to drive price volatility in a fixed income portfolio. So the more volatile interest rates are, the greater the volatility, the greater the price volatility is going to be. So it's going to be especially important when securities have embedded options, because options are going to be sensitive to changes in volatility, right? So if you've already gone through the option portion of the curriculum, well, then you know that one of the determinants of the value of an option is volatility. We'll get to talk about this again later. Long maturity volatility is associated with uncertainty of the real economy. So the long maturity volatility, so how interest rates change in the long term, that's driven by sort of real factors like how's your productivity changing? How innovative are you with technology? What do you do in R&D expenditures? That type of stuff. Okay, whereas short-term maturity is going to be really sensitive to monetary policy, which we get updates on monthly about what the Fed is doing with interest rates. So we would expect that, given that short-term rates are more sensitive to this thing that we manipulate, that is monetary policy manipulating interest rates, we would expect to see volatility greater in the short end of the maturity spectrum. All right? And that wraps up this relatively long reading. So I realize it took a long time to get through this. There's just lots of material here. I think this is worth getting on top of, though. So getting a foundation here is going to help a lot with interest rates as you go forward. So what is going to be important? Spot rates, forward rates, I think are really important. Yield to maturity, that's something we learned at level 1, but you ought to make sure you can calculate it. Expected and realized return, so that was our discussion of reinvestment risk and the shape of the yield curve. Well, spot rates and forward rates, I think, are of paramount importance. These other things are also important, but maybe less so for calculations. Active bond management, this is the idea of riding the yield curve. Do you understand why that works and what violation of pure expectation has to occur for it to work, right? So interest rates can't evolve like we see in the forward rate curve. Swap rate curve and the swap spread, something you want to have a handle on. I think the Z spread is going to be really important. The TED spread and the LIBOR OIS spreads are also going to be, worth knowing about. We're going to take this Z spread and we're going to companion it with some other stuff in future readings that is going to make this seem a lot more important than the TED spread, I think. So term structure theories in terms of pure expectations, biased expectations, segmented markets, those things, versus modern models. That's the Vazicek CIR, Ho Lee models. So you're going to want to know a little bit about each of those. So that gives you, what, 5 theories and 3 models. So there's 8 things there that you want to be able to know about and maybe compare and contrast to some extent. And then measuring and managing yield curve risks, that refers to what we were talking about in terms of the key rate duration and non-parallel shifts in the yield curve. So a lot of information here. I would urge you to make sure that before you go on, you feel comfortable, at least, okay, with spot and forward rates. Okay, you also ought to be comfortable with this managing yield curve risk stuff here at the bottom, and the Z spreads. So if you don't get those things down, then there's going to be just a lot of things that are going to be mysterious as you progress through this fixed income material. Good luck.